Looking back at 2024, the Sharia portfolios have generally performed quite well. A lot of that has been driven by, again, renewed optimism for US stocks, particularly within the AI, theme. There are, the typical names that you're seeing, Nvidia, and other AI players that have helped push the market higher, and the Sharia portfolios have benefited from that. However, looking back over Q3, specifically Q3 earnings, we have seen some weakness or earnings that have come in just short of investor expectations, and because of that the Sharia portfolios have seen some downward pressure, particularly within US exposures within the portfolio. However, we remain optimistic around AI and the US equity markets more generally. But in the short and medium term, we have looked at other areas to tilt the portfolio, specifically multi-asset strategies that we've been invested in for the good part of this year. We've increased our exposure there. We've maintained our exposure into precious metals, which typically do well in a weaker dollar environment and when real rates come down. So these are areas that we've used to defend the portfolio, but also make us optimistic about the outlook for these assets. As we continue to work with various other asset managers that are looking to launch Sharia products and have some input in the type of products that we would like to see. As time goes along, we're able to construct portfolios that are more capable of defending against different types of forces within markets, and give us an ability to diversify your portfolio and ensure that we're not only able to defend but also take advantage of the various types of assets in the global universe. This is an exciting time to be a passive investor, predominantly because of the fact that we're looking to reduce the cost within the portfolio as well as make more enhanced investments. So firstly, let me talk about costs. As you all know, passive investments are significantly cheaper than active strategies. But even within the passive investment universe, fees are being pushed lower, and we've been beneficiaries of that by being able to select the best-in-class ETFs or index funds that track a relevant market at the cheapest costs. And off the back of that, we've been able to create a portfolio that is significantly cheaper than what it was a couple of years ago. So that's been a great benefit to the passive portfolios this year. On the enhanced element, we're seeing a lot more types of strategies that look at tracking an index in a more sophisticated way, or alternative ways of tracking an index, whether that's looking at factors, equal weight exposures to constituents within an index, or looking at smart beta type strategies. These are all alternative ways in which you can track an index and boost the performance profile of the ETF or index fund that we're invested in. So these are the two areas that we've been looking at, and we've been combining them to create a portfolio that is cheaper and has the ability to outperform the benchmark over a specific time period. We remain optimistic about the opportunities that are presenting itself within the passive universe, and we expect between this year and next, fees will continue to come down and more sophisticated products that track indexes will make us even more excited about the ways in which you can have exposures to different asset classes, markets, or sectors.